In this video, we are going to discuss about the different methods of the valuation, like what is the number of valuation and how business valuation is play a crucial role in the fundamentals of the company. So valuation of the company is, it's a benchmarking for the another company, and we can calculate the value of a company for the different purposes, whether it is for M&A, or we can say that the fundraising, equity share price, ESOPs, etc. So what is the, these are the three common methods of the valuation used in the businesses. So we start. First one is the DCF valuation. So the DCF one. Then how to figure out that. So DCF valuation is something that estimate the intrinsic value based on the present value of the expected future cash flow, discounted at the appropriate discount rate that reflect the riskiness of those cash flows. So this is something like that you want to earn in the future. It's a $10,000 per month, but right now you are at the $100 per month, but you want to expand it on the more crucial concept. So this is the DCF valuation. So it's estimate the intrinsic value, like the present value of the expected cash flow, what is the future cash flow I'll receive in the future, and on the basis of that I discount it at the appropriate discount rate that reflect the riskiness of those businesses. So this is something like that. Then you have the comparable companies, or you can say that the company analysis. So this is something like that, value a company by examining the valuation of similar company. So we can say that in the same industry or same sector, and compare the financial metrics and ratios, like with the comparable, calculate value based on the reasonable multiple. So this is the comparable company valuation. So valuation of the company depend on the examines of the valuation of similar company, same industry, same sector, compare the financial metrics, ratios, comparable, calculate the value based on reasonable multiples. So this is one thing. Then we have the precedent transactions. So we can say that the looking at the prices that paid in the past transactions for the company that are similar to the one being valued, or we can calculate the valuation based on the most applicable multiple. So we can say that the precedent transactions on the basis of past transactions, or the pre-transaction, something like that. So this is the pre-transaction multiples. Then when to use the ease method. Let's say when there's a reasonable and reliable cash flow projections are available with the excellent foundations in the proven historical figure. So when there's a reasonable, the reliable cash flow projections, you have the projections of the business and you want to project the business cash flow on the basis of that, then you can use the historical figures for them. So we can say that's a DC evaluation, something like that. So what is the use of the comparable valuation or comparable companies? When there's a well established companies in the same sector or the industry with the public available financial data or the valuations, or at any differences, we can say that that can be reliably adjusted, or this is something like that. So we can say that the comparable companies are there. Then precedent transactions. So precedent transaction is something when considering the M&A, or when you want to see what acquirers have the historical paid for the similar companies. Let's say when they want to see, and what is they want to pay for the precedent, or the we can say that the previous transaction or something like that. So this is the M&A, and the acquirer want to historical paid for the similar companies. Let's say for the working companies working in the same space, so we can say that are similar companies. So this is something like that. Then what is the strength? So it's a focus on the DCF is focus on the future cash flow that the business is expected to generate. It's allow for the sensitive analysis which enable the investors to test the impact of the changes in assumptions, or we can say that the inputs on the valuation. So it's something like that. It's a focus on the future cash flow that businesses want to expect to generate. So this is one thing. And another one, we can say that it's a comparable company analysis. So this is something quick and easy to implement based on the real time market data. So useful when there are the many comparable public traded companies. It's a very common use and a widely accepted method. You can say that it's a widely accepted method for the different purpose or the things like that. So this is one. And this reflect the real world data, and the another one is a precedent reflect the real world data on the what acquirer have paid, and the incorporate a control premium, like this is the premium an acquirer typically pay over the market price to obtain the control of market. So this is the one thing. Then we have the another thing like the weakness. Like what is the weakness of that? So it's a highly sensitive to the assumptions about the growth rate or something like that, because the discount rates are very stable for the companies. What is the weakness of precedent transactions? So the market variables are correct, difficult to find the comparable companies, and this is always available for them. So this is something like that. So this is all for the video. Let's meet in the next video with the more better content.